Hello, everybody. Rod here, Rod Spratley, and I am super excited because I'm getting to talk about one of my favorite subjects. And there's nothing I like more, folks, than coming up with creative ways to do what the wealthy do. Really, it's creative ways for a lot of us that didn't know about the things that existed that can help us to actually succeed in building wealth and building it faster. One of the things that I found out about years ago is something called the First Lien HELOC, not your traditional HELOC. This is called a First Lien HELOC. So, what I want to talk to you about today is I want to give you some insight, some background into this, let you know how wonderful this product is and how you can use it to be able to do a myriad of things. We'll get into those things. I'll explain some details around it. But one of the things I want to encourage you with right here is look, lean in, listen closely, because I'm going to share some things that you probably do not know. These things will help you. It'll help you to pay your mortgage off in 5 to 7 years. It'll help you to create a source that you can utilize as a bank to do other things for your family, to be able to pay off debt or consolidate, to be able to send your kids to college, to be able to purchase real estate. There's a number of things. So, what I'm going to do is I'm going to jump into this and walk through some steps of what I learned about this great product years ago from a mentor and friend of mine, or a person that became a great friend of mine, that actually helped to write some of the regulations around this product that some of the financial institutions utilize to this day. Okay, so just a little back history, a backstory on this. So years ago, probably about 20 years ago, I met a gentleman. He was an attorney. He was a friend of ours. We were doing quite a few real estate transactions together. And we came upon a deal one time, and he said to me, well, hey, look, I can loan you the money for a short period of time, which I thought was pretty great of him to offer. Of course, he did want interest for that loan, which is you know, not unusual to hear that obviously someone would lend you some money to make money. That's the way you make your soldiers or your dollars work. You put your dollars to work by putting them out to make money. So he made an offer to loan my wife and I a substantial sum of money. I think it was like $325,000. We were doing a real estate deal. The lender that we had at the time, uh, it didn't fold, but it was just dragging out. And we were trying to close this deal, and we were at risk of losing the deal. And he offered to actually lend us the money for 12 months, which would have been the time we needed to kind of get the deal off the ground. It was actually a new construction deal to get the home built, get it on the market and ready for sale. So we said, so absolutely, we'd be interested. So he presented to us, he said, listen, give me about 3 days. He said, what I'll do is I'll lend you the money, and I'm going to get it from my HELOC. Okay. And when he said that, I was like, well, why would he take money as a loan and loan it to me? Because I'm thinking, I thought maybe he had the cash. Well, this is the key piece. He did have the cash, but he didn't use his cash. He used his HELOC. He had a first lien home equity line of credit. That home equity line that he had at the time, he was paying something like 4.75% on that money. Now, he shared this with me. He said, I'm going to borrow it at 4.75. He said, but I'll lend it to you at 10%. Okay. And so I'm thinking at the time, okay, well, you got it at 4.75. You're going to lend it to me at 10. Right. Which is exactly what he did. So tax free, he took money out of his home. He didn't pay any taxes on that. He lent that money to me for 1 year at 10%, and he made 5.25% interest on his money. And obviously, when I paid him the 5.25% interest, he just took the balance of which he loaned me and paid it back to his HELOC. Thus, he was ahead 5.25% on his money that he lent out to us. I thought that was absolutely phenomenal. Hadn't heard that before, didn't know anyone had done that before. I'm sure many people had. I just didn't know about it. So I share that story with you before I get into this, because that's what this product will do. It would allow you to do all kinds of things. I call it the secret bank. Okay. You make your home a bank. Now, there are some parameters around this. we have to already make some assumptions, or I'm going to make some assumptions in sharing this with you. Number one, hold on for a second. Number one, you're already financially responsible. And by financially responsible, I mean, if you're listening to me and listening to this, we're talking about investing. If you know anything about my wife and I, everything that we get into has to do with building generational wealth, creating passive income portfolios, buying real estate, and basically building wealth. We don't really get into the nuts and bolts of the type of stuff that the Susie Orman or somebody, a Dave Ramsey might do, which is teaching you how to become debt free and how to handle your finances. All those things are great, but what we're really teaching about is teaching you how to use your money and make money, okay, and how to build passive income and generational wealth. And I believe that this tool is critical in helping you to do that. So when I say that you're already financially solid or financially savvy, here's the things that I would consider or what that means. Number one, you're a person that, you're financially responsible as it relates to your credit. Okay, that you have a decent credit score, which means you're credit worthy. That your credit would probably be certainly in excess of 650. It should be in excess of 700, which would make it better. But certainly if it's in excess of 650, and I would say specifically for this product, at minimum a 680 credit score. You want to have that. If you don't have that, this product could right out the gate be a challenge for you. Number two, that you have a positive monthly cash flow. That means that if you make 10 grand a month, you're not spending 12 grand a month, which means you would be in a hole. It means if you have a 10 grand a month income, I mean, maybe 60% of that is spent for expenses, your mortgage, your car, your insurance, things of that nature, things that you would need, your food, and just monthly upkeep, the utilities and things. And certainly you have some discretionary income left, whether that goes into some sort of retirement or you put it in a savings or money market or whatever it is, but you're not spending up to the max of your income. Debt to income ratio is what I would be referring to. And you want to have a good debt to income ratio. I would say again, and I'm not the mortgage lender, I'm not the bank. I'm telling you from experience what I've learned that works well with this product. You would want that to certainly be favorable numbers. Okay, your debt to income. You don't want more than 70% of your monthly income going out for expenses. So I would say that would be your max that you want to be going out. You want to show a positive monthly cash flow because you're going to find out with this product, that's how this product works the best. Okay. Last but not least, you're financially savvy or responsible so that you're not an individual if you got access to say a substantial amount of cash tomorrow, you would look at that as what can I do with this cash to now make more money. You remember there's a story in the Bible about the talents where each servant was given a certain amount, and the master went away and he gave that to them to take care of while he was gone. Two of the servants did very well with the money, and they doubled the money. Okay, one of which had the largest sum of money certainly doubled that and made double that amount. You had one of the servants that basically said that he was afraid of his master because he thought he was an austere, I guess we'd say a, a shrewd businessman, and that he would expect a return on his money. So instead of him taking a chance or risk, he just put the money, I'm going to say under the mattress for this story, the way that I'm telling the story, and basically just gave him the same amount of money back. Well, the story went this way. The master came back. He was so proud of the individual that had doubled the money. He took all the money from the others and gave it to him, the one that had done the most and made the most. But for the gentleman that stuck it under the mattress, he said, at minimum, you could have put it in a bank or somewhere and through just a minimum amount of interest on the money, but instead you did nothing with it. So this is about being financially responsible. That's what that whole parable and story is about. It's about being financially responsible. This HELOC product is for people that are financially responsible. So here's what I'm going to do. I'm going to share my screen. I'm going to show you a few things and I'm going to walk down through this. This is not an all-inclusive, but this gives you the highlights of what this product does. And at the end of that, I'm even going to share with you a place where you can go and run your own mortgage calculations to see the difference between what it would be like if you had a HELOC and how fast you would pay it off. So let me share screen. Bear with me here and let me get my presentation up on the screen. Okay. Now, hopefully you can see that. Okay, I'm sharing the screen, so I am going to assume that you guys can see that. Okay. And here's what it's going to allow me to do. Okay. I'm going to talk about a few things. Number one, home financing kind of 101. This is just financing. A traditional 30-year fixed mortgage usually just it sits in first position. First position means that your house is actually on the line as an asset for that mortgage. Okay. And this is what people traditionally do when they buy houses. You buy a house, the house gets appraised, and then they say the value is, say, 500,000. They loan you that amount of money for a fixed interest rate. You pay it back over 30 years. Well, that's what everyone's used to. Okay. And you pay an enormous amount of money back over 30 years because the vast majority of that product is leans itself towards the interest. So when you look at a lot of these, if you ever look at the fine print on your mortgage, when you sign all these papers and it gives you that amortization schedule, it basically it could scare you if you look at it too closely. Because if you bought a $500,000 house, you probably pay back almost $1.5 million, if not $2 million, depending on your interest rate, especially with the rates being a little higher now. You pay back enough to buy 3 houses in 30 years. Okay. But a traditional HELOC and what most commonly people will call a home equity loan, usually when people think about HELOCs, they sit in second position. They're not in first position. And so with that second position, it means that the first mortgage is first, which is fixed, and then you have a second position HELOC. We're not talking about that product. That's not the product we're talking about. And a HELOC here is more like a credit card that you can withdraw and use and pay interest on the amount that you withdraw. Okay, that would be that second lien, or if you had a first and a second. So now you're paying back the first mortgage, and you would be paying back the second mortgage, usually at a higher interest rate. A first lien HELOC is a combination of a traditional mortgage and this second lien or this HELOC product combined. Okay. So what it is the first lien HELOC is first position. The asset is the home. It's not in second position, but you can use it like a credit card. You can draw off of that and you utilize that money when you need it and put it back if you don't need it. Okay. And draw out any of the equity that's in the property. So let's say it was your home currently is valued at 500, but you owe 350. Well, if you get it appraised and it appraises at 500, you are sitting on $150,000 worth of equity. Even though most HELOC products probably will not let you draw out 100% of that equity, they certainly will let you draw out as much as 90%. Okay. So you can see right there where you would have this ability to be able to tap into and utilize that as an actual line of credit, or as we say, like a credit card. Now the thing that's so incredible about this, guys, and I'm going to go back somehow. I moved a little quicker than I wanted to. The thing that's incredible about this that a lot of people don't realize or don't know is that you have so many opportunities with this, be able to use this for different things that would benefit you tremendously. I'm going to shift my computer around here a little bit, and so I can see a little better because I've got two screens up. Okay. So here's the thing. If you're familiar with home equity line of credit or HELOC as the way it's used in your equity to access your house, your cash or your equity in your house, people use HELOCs for all kinds of things. They use them traditionally doing home improvement, paying down debt, educational expenses, things like that. And they use them from that perspective, as most people have known about, they use them in like a second position. Like I said, it's not used as a first. Okay. But using this process as a first is an option to replace your mortgage and also to give you all the access to the equity and not just as a second mortgage or a smaller mortgage. This is any equity you have in your home, and you can use that over and over and over. You can use it, pay it down, you can use it again, you can write a check, you can do that. And that is one of the great things about the product. Okay. Additionally, you're maximizing your cash flow strategy. Okay. And what you'll find as we go further with this, it allows you to pay off your home in as little as 5 to 7 years, really without changing your lifestyle. Now, that's the incredible piece of this product that's like, I mean, just mind blowing when you look at the details of it. Okay. The differences between a first lien HELOC and a mortgage. Okay. A first lien HELOC has the following key differentiators. Okay. There's key differences between a first lien HELOC and a regular mortgage or a second HELOC. Okay. It allows money to go in and out freely of this account. Money can go in and out. And I'll talk to you about that. It's a sweep account, is the way it is set up. It calculates and earns interest on the average daily balance of the period. It calculates and earns interest on the average daily balance of the period. Okay. And I'll explain that further. It allows you to only pay the interest, no principal. You're only paying the interest. Okay. And it acts as a line of credit, like a giant credit card, and that's what makes this thing so phenomenal. Okay. It has tremendous flexibility. Okay. Traditional mortgages are rather rigid and the financing options, whereas a HELOC can allow homeowners to access capital, consolidate debt, to pay down principal balance quickly. A HELOC calculates its interest based on the previous period's average daily balance. And this is where you can exploit this loophole. Okay. So it's the interest based on the previous period. So the previous 30 days of that daily balance. Okay. And that's what it's based on. And there's a loophole with this because you know that when you have a traditional bank account, if you've ever balanced your account at the end of the month, if you have a checking account, you notice there's that line on there that says average daily balance and then average like monthly balance. So let's say you had $50,000 going to your account in 1 month. And you had expenses. So in this checking account, you might have had, you know, $41,000 of expenses. But because of the way those debits come out of the account, because of the way things hit, you may very well have an average daily balance of you could have $20,000, $30,000 average daily balance with $50,000 going into your account a month. Doesn't mean that you necessarily had that much cash on hand, but if it's the float is what I refer to it as. Okay. That money in a first lien HELOC pays down your principal balance. And because it's based on a average monthly balance for the previous month, if you can do that in that cycle of time, your principal balance would have been paid down by 20 to $30,000, which means you would not have paid interest on that money. Okay. So that kind of gives you an idea and hopefully you can see how this works. Okay, so the primary difference is it allows money to go in and out freely. That's what I tell you. It calculates interest on an average daily balance of the period. It allows you only to pay interest. There's no principal payments with the first lien HELOC because you're using this account and whatever you put in there daily at 12:01 a.m., it sweeps from your checking account over to your mortgage account and it pays that off your principal. This thing is tremendous, folks. I'm telling you. Okay, here's an example. Okay. So this example that you see, it's a regular mortgage and a first lien HELOC. Okay, let's say you had a regular mortgage at 3.5%. You had a first lien HELOC at 5%. Okay, your monthly income. Now this is where you get your understanding with this. Let's say your monthly income, you had $12,435 go into your checking account for the month. Let's say you got paid biweekly, you and your wife or whatever income you have going into your house. If you're single, it's $12,435 a month. Your monthly expenses are $5,788 a month. So you can see that 5,788, that's not the vast majority or that's maybe what, 60%? Oh, it's not even 60, that's 50% roughly of what you brought in for the month. Okay. So your amount financed is $422,000, and your average loan payment for that mortgage at 3.5% was 22.95 a month. Okay. That's a fixed 30-year, and the total interest paid. Look at this number. Total interest paid is $260,188. Okay. That's the total interest paid for a 30-year regular mortgage at 3.5%. So even though 3.5% sounds so great, you do see that if you carry that mortgage for 30 years, you see how much you're paying back. Enough typically to buy certainly a couple houses. That's the way I always look at it. Okay. On the first lien HELOC, now look at this. Your interest rate is not as low. You actually have a 5% interest rate, but you have the same monthly income, $12,435. You have the same monthly expenses, $5,788. You have a fixed amount, which was the amount that you borrowed, which was the $422,000, just like your traditional 30-year mortgage. Now, the monthly payment is interest only, not principal and interest. So the mortgage is principal, interest, and insurance and all that. This is just interest only. So you see your interest only payment, it's $929. Now, if you choose this first lien HELOC, just like you did with the 30-year, and you compare these two, and you didn't change anything, and you kept that same amount of pay or same rate of pay or same rate of monthly income, and you kept generally around the same amount of monthly expenses, you would pay your mortgage off in 7.5 years. 7.5 years. And the interest would have only been $85,000. Now, guys, I don't know if you're tracking. I hope you're tracking with what I'm giving you here. Like I said, this is a high level kind of an overview. There's some more details around this, but I wanted to get you quickly with this into the benefits of it so that you would know if you think this fits for you to go to the next step, which and the steps would be to obviously go ahead and do the application, get all the paperwork. There's some more details and things that you will be provided, current interest rate, things like that. And obviously, this would be applicable as it relates to where you are and what you currently own in your house and if there's equity in the house. Okay. But is that amazing or what? I mean, to me, when I saw this years ago, I was like, cannot believe, cannot believe that all these years I had purchased homes with a traditional mortgage. Never again, my friends, will I ever purchase a home with traditional mortgage, ever. And I'm working on currently right now doing the same type products on my investment properties. There are lenders that do it. We're working on deals now that would allow us to be able to do that. And I can put this resource on my investment property that I could use them the same way. Okay. Isn't that powerful? Okay. So you get this flexibility I talked about. You get now, I'm going to show you and give you some more details here, like a side by side comparison. I gave you the example. Now, what you see is a side by side comparison, and that is a mortgage versus a first lien HELOC. And it kind of gives you the two different things. So, interest calculation on a standard mortgage is previous month's balance, the previous monthly balance, which usually, if you borrow $422,000 and you pay in mostly interest only up front, your balance is going to still be $422,000 the next month and the next month and the next month. Maybe they took $2 off. Okay. But on a first lien HELOC, it's the average daily balance. So if you deposit $12,455 or whatever it is into your account, the day that went in there at 12:01 a.m. that night, that money would transfer over to your mortgage, which would have paid your mortgage balance down by that same dollar amount. And every time you put $5 in or $10 in or $20 in or whatever you can put in there, is going to decrease daily your principal balance, which means your interest is going to be less. Okay. That's why you could pay a higher interest rate and still pay less mortgage back. Okay. Because it's daily versus monthly. Right. So then you've got cash deposits. The cash flow really is deposits only. In a mortgage, you don't really have a cash flow. You just put the deposits in. But on a first lien HELOC, you can withdraw, and you can deposit. Okay. You do both. You can use it like a checking account. So you can make a withdrawal and you can make a deposit and it's real time. You don't have to wait 4 days for the money to transfer or 5 days. This happens almost real time. Okay. On a mortgage, escrow is required. And what that means is they're going to escrow your taxes and your insurance and any other fees for you in advance. Now, some people, maybe this is not a big deal. I don't like people holding my money to pay something later. So basically, they take money out all year to pay these yearly fees, and they take them out in advance and they escrow it. You don't make any money on what they're escrowing all year. They take it out and then they pay it at the end of the year. Okay. On a first lien HELOC, this is excluded. You pay your taxes directly yourself. You pay your insurance, your premium directly. You pay that yourself. It's not included in the loan. Okay. And then on a mortgage, you've got monthly payments. On a first lien HELOC, you have interest only payments. Okay. So it gives you some discretion. Let's say 1 month you needed to, something was going on and you had a few things that came up that were fairly large expenses. And you said, well, hey, I'm not really going to try to pay anything additionally. I'm not particularly worried about the first lien HELOC. I've got big stack of equity there. I'm sitting on 50, 60, $150,000. You can only make an interest only payment for months, okay, and which is the minimal amount. You certainly can do that. My payments come out automatically. So I have my payment set up, they automatically draft out of my account. I don't even worry about it because whatever else I put in there, I'm paying the principal balance down significantly anyway, which is far more than any payment would be. Okay. So hopefully, again, like I said, you guys are tracking what I've got here. And this is the other ways that we see traditionally a first lien HELOC product is used. Okay. You can purchase a new home with this. Okay. I have a friend right now. They purchased out of his HELOC. He purchased a condo in Sarasota, Florida at the beach. That condo was 455,000. Well, I think he said it was 655,000. He purchased his condo, 655,000. He drew that money of his HELOC and paid for, and now this is all I'm gonna share why and what he did with this, but then I'll tell you he didn't keep it in there, but he did it to close the deal because it was a great deal. The condo was worth far more. It just needed some renovations. It was kind of a distress sale. He took that money out and paid for it cash. Went in, fixed up the condo, did new kitchen, put in new flooring, brought it up to the current value, which is almost like 800,000. And then he refinanced it, put a HELOC on it, and actually got his money back for his other HELOC and let that money for that property set in there. But I mean, to be able to move quickly, I mean, literally, it's as easy as writing a check. Okay. You can consolidate debt. If you got a lot of debt, oh, credit cards are horrible. You're paying 20%, 25, 30%. You're carrying these large balances. Yes, and people do pay 28% interest on some credit cards. It's crazy, but people do. I would assume that probably you listen to me. You probably don't, but hey, you can consolidate debt. This interest rate's a lot lower. Okay. And that means you can accumulate and keep more monthly income in this account. You can invest in real estate. Cha-ching. This is what I do. We do real estate. This is what I use my HELOC for. I have purchased in the last 6 years 4 properties using my HELOC, paid for those properties or did renovations on those properties. Keeping in mind that I'm just going to give you I'm a sidetrack to a little bit here for a minute. I'm going to tell you I'm not a tax strategist or an accountant or any of those things, but I'm a long-term investor, been doing it for 28 plus years. And I've learned from my team, my accountant, my tax advisor, my lawyer, these other folks, strategies that allows me to do things that I benefit from. One is I can take money out of my personal HELOC and lend that money at a higher interest rate than I took it out, just like the story I told you about. I then lend that money to myself or to my company. Let me correct that. I lend that money personally, either as a principal or as just a private lender to my incorporated company. I loan that money and then allow that money to be used at a higher interest rate that pays me back once their transaction is finished, along with my interest, I put my HELOC back and restore that. And I just made myself some additional cash. Legal, you can do it all day long. This stuff is phenomenal. Okay. It can help you to navigate your retirement. Many people are concerned about their retirement. They're not sure what's going to happen. The 401k is up and down. Their other investments are, not necessarily producing the way they want. You can pay your home off instead of taking out a reverse mortgage. Let's say your home is worth $800,000. You've paid it off with this HELOC all the way down to $20,000, $30,000. You can utilize that money in your home tax free. You can write a check on it. You can use it for as long as you need to use it and still have the home pass on to your heirs when you get done. And hopefully we'll continue to grow and still have equity in it. This thing is a power play, my friends, and that's why I think it's so great. Now, here's what I've got for you. I'm going to give you a little nugget here. You'll see firstlienheloc.com/calculator / That's HTTPS colon / You see it on the screen. First Lien HELOC. FIRSTLIENHELOC.com / and that's CALCULATOR. Just in case some of you can't see the screen and you're listening to me, I spelled that out. Now, here's what you can do. You can pull up that calculator, and that calculator will allow you to take your current mortgage that you owe on your house and your details and plug them in. And then it will show you the difference if you had a HELOC versus your traditional mortgage. If your traditional mortgage now is at 4.5%, 5%, you plug that number in. And the HELOC rate, let's say it's right now 7.5%, which don't let that disturb you in any way. You need to do this to look at the bottom line number of what your paid mortgage interest would be. I think you're going to be shocked, my friends. And I think you, like me, would agree that this is an absolutely phenomenal product. And this is something that if you're very wise, which I believe that you are, you would want to look into and see if you can now set this product up to be something that you and your family can utilize to help do whatever it is that you've chose to do with allowing yourself to be able to have access to these funds. But even if you don't use the funds, think about what you save yourself in interest, because this is a two there's many different angles with this, and one could be you don't really need to use the funds. You just let it sit and pile up like a bank, so in case you ever did need the funds, it's there. You're still going to pay that mortgage off so much faster and pay so much less interest that you have to look at this very seriously. So I'm going to stop my share right now. Like I said, I appreciate the time and opportunity to be able to come to you guys to give you this info. I'm going to make myself available. And so if there are questions or additional things, this is not something I've released necessarily fully yet. This is something we're working on doing to be able to put it out there to teach it and to allow other people. I can get you linked into my folks, which are the people that I do my mortgages with, because I think they're phenomenal. I'm a personal friend of the individual that wrote the rules and guidelines around it. And I just think that personally, they handle this much better than some of the other banks and financial institutions that do it. So I hope that this has been helpful to you. I hope that it has enlightened you tremendously about the first lien HELOC. My friends, don't lose out. Don't miss out any further. Do yourself a favor and get all the details and get this moving as quickly as you can. This is Rod, and for right now, I would just say peace and have an absolutely wonderful day. Okay? God bless.